Last week, Canadian banks reported their earnings and final numbers for the year. Some good news, some bad news, a lot of provision for credit losses. So let's wrap it up today with this Q4 2023 Canadian Banks earnings review. Dividend growth investors, bonjour. My name is Mike Yehu and I am the founder of Dividend Stocks Rock. I'm also a passionate investor and I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. And if you are about to retire or if you're retired and you're Canadian, you probably have a few Canadian banks in your portfolio because they have been known to outperform the market, be a solid foundation in a portfolio, good balance between growth and dividend. But since the beginning of this year and actually last year as well, it hasn't been such of a party, right? So if you look at this graph where we see EQ Bank and GoEasy that are completely in a different world in terms of returns since the beginning of the year, with 41 and 33% total return for both of them. We're not going to talk about those today. We will focus on the big six, but I just wanted to show you where they stand. All the other banks are under the market. So the market is up 8.55. CIBC, National Bank are still doing not that bad at 8% and 6.72, but for the others that hasn't been such a great year. And one thing I want to show you here is I also put the ZWB and ZEB, the ETF that tracks banks and the ETF that does a covered call. And unfortunately, the covered call once again underperform the ETF that tracks bank. It's kind of counterintuitive because when you are in a down market where banks are going down, technically selling options on those, you get the premium, but you don't sell the shares because the shares keeps going down. You should be making more money than the opposite. Still not happening. So long story short, when you pay for yield, you leave money on the table. Unfortunately, this is again this case in 2023. So now let's dive into the most important part, the most exciting part, earnings and dividends. So on this chart, you will see the results for the big six banks. So what I did is I show you the next dividend payment that will happen shortly in 2024. All banks announce a dividend increase besides Scotiabank. Now, some people will tell me, but Mike, historically, Scotiabank is not increasing their dividend on Q4. True that, but also historically, Scotiabank offered 2 dividend increases per year. So forget about 2020 and 2021 because of COVID, but before that, Scotiabank used to increase its dividend twice a year, such as BMO, National Bank, Royal Bank, and CIBC. Actually, there's only TD that increases once a year, and this is why you see that it's a little bit higher than the others. But long story short, Scotiabank fell short again this year with a small 3%, not even 3%, like 2.91% dividend increase for 2023. So the second column that you see is the total of the 2 increases for all the other banks, or for TD, that is at 6%. National Bank, big winner in this category, 9% dividend increase. TD, BMO, and CIBC are doing well at 5-6%, and then Royal Bank a little bit behind at 4.55%, and Scotiabank way behind at 3%. Keep in mind, last year it was exactly the same story, so I'm starting to get a bit disappointed here. The adjusted earnings for 2023 for the full year, you can see it goes not really up, right? We have good performance for Royal Bank, up 2%. Most of it, though, was due to lower taxes this year than last year, so it's not necessarily something that is recurrent, and it's not that great from a business point perspective. All the others, BMO, TD, CIBC, and Scotiabank, were hurt by provision for credit losses, higher expenses, and while National Bank still had higher PCLs, provision for credit losses, they were pretty much flat. It's actually a little bit under because last year they made $9.61, so today it's like 9.60, so it's not exactly flat. Just want to be fair here. You see the yield, so that's the dividend yield forward for the considering the new dividend increase expectations, and the payout ratio. For the payout ratio, what I calculated, it's not exactly the exact payout ratio because we do expect other dividend increases, and we're using the new dividend payment. So what I did is I took the next dividend payment, for example, for BMO, $1.51, multiplied that by 4 and divided that by the latest adjusted earnings per share for the year. So it's an approximate payout ratio, but to be fair, we would have to take the past 4 dividend payments to have the perfect payout ratio. I just wanted to show you that if everything stays the same next year, the dividend stays the same and the earnings per share stays the same, this is what the payout ratio would look like. Again, everybody's like in the 50s. We have Royal Bank and National Bank a little bit better at 44 and 48, which is kind of great. And then again, the same laggard, BNS at 65%. So now 65%, it's not a right time to start to freak out, but it's just that we're definitely not going towards the right direction, and it's been several quarters now that the bank is struggling. So now we're going to look into their quarterly earnings result by segment. So one thing I added on this chart for this quarter only is the growth of provision for credit losses, the last column, PCLs. I wanted to show you the increase that goes from like 24 at CIBC and 32 at National Bank all the way up to 97 at BMO and 136 at Scotiabank. The reason why I wanted to show you that is not to say, oh, BMO and Scotiabank, you should freak out and all the others are pretty cool. It's more to show you how it could influence their results and their earnings. Keep in mind that each bank will follow similar rules, but will not necessarily apply exactly the same vision on their provision for credit losses by looking at their loans. So depending on how they want to interpret their loan portfolio, we may say higher or lower PCLs as well. So it is an indicator, but do not necessarily compare one to another. The perfect scenario to illustrate that is when we had the COVID hitting the banks, well, hitting the market in 2020, all the banks but Scotiabank increased their PCLs massively the following quarters. Scotiabank waited another quarter and then did the similar increase in PCLs, but just in Q3 instead of in Q2. Does it make a real big difference at the end of the year? Not really. So do not necessarily to panic, but again, Scotiabank, lower dividend growth rate, higher payout ratio, not performing, and then higher PCLs than anybody. There's definitely a narrative over there. So down 31% for personal and commercial, which was pretty bad, up 13% for that last quarter for their international segment, which I was quite surprised. But then wealth and capital market down 9 and 14%. So overall, not a good quarter for Scotiabank once again. One bank that surprised me was CIBC with a jump of 21% in personal and commercial. So yes, they had higher PCLs, but they did a lot of client acquisition. So their volume was stronger, and this is why they were doing well. PCLs in the US, their adventure in the US is not doing that well, minus 69% for this quarter. So definitely not a good timing for them to be there. They're struggling, but we can see that TD is also struggling in the US, so it's not necessarily like a good pattern for everybody. On the other side, we have BMO that posted double-digit growth due to strong US dollar, and National Bank did very well with Credigy. So it's really not the same business for each bank. On the other side, BMO did well for PNC such as CIBC, but all the others, especially National Bank, down 14%. Greatly affected provision by credit losses. So their quarter was saved by capital markets. And I keep telling you that capital markets are highly volatile. So you see BMO and National Bank up like 40%, 37%, Royal Bank up 36%. And then you see CIBC and Scotiabank minus 22 and minus 14. It's kind of hard to wrap your hand around those numbers, right? But this is the way it goes. Sometimes they make a lot of money with global markets or with investment banking. Sometimes they have to take higher provision for credit losses, or the market is not on their side depending on the type of trades they make. So It is highly profitable to be in this segment, but it is also highly volatile. You have to be careful with that. So overall, this quarter was pretty much the continuation of last quarter, where PCLs increases, all banks are making more money in interest income because higher volume. But again, when they look at their loan portfolio, they're kind of like ringing the alarm where they're gonna have some problems over there. So the negative amortization means that some clients had variable mortgages, but they were making fixed payments. So if you're paying $1,000 a month and your interest on your loan is now $1,200 because interest skyrocketed, well then every month you're owing $200 more to the bank. So that creates a negative amortization because you're not bringing that loan down. There's no problem as long as the customer makes the payment. Actually, it's even better for the banks at this point because they're making a lot more money in interest income. The problem will come when they try to renegotiate, and then maybe some clients will say, you know what, take the keys. I can't afford a payment of like $2,000 a month. I used to pay $1,000. That's way too much. I cannot do it. I cannot breathe. And this is where problems could start happening. But depending on how many customers will give up keys versus all the others that are going to just tighten their budget and keeps paying, it will have a different impact from bank to bank. So we'll have to wait a little bit more and follow the PCLs to know where it's going. To end up this video, we're gonna take a look at the valuation. As you can see, TD Bank skyrocketed, but that's in terms of PE ratio, just because that the latest earnings, not adjusted earnings, but earnings included a lot of amortization, restructuring charges, and also termination fee for the acquisition of First Horizon that they decided to cancel due to the bank saga earlier this year. If we move to the forward PE ratio, we can see that all banks are valued between 9 to 11 times their earnings. CIBC is the most undervalued stock, but again, lack of growth will not necessarily help them. What I don't like about CIBC is their lack of strategy overall. They're trying to do a little bit everywhere, where you're going to find we're going to find banks with a clearer strategy, such as TD expanding in the US, Royal Bank and National Bank being like 50% of their revenue coming from classic activities such as loans and savings, and the other half is with wealth management, capital markets, insurance, and others. And BMO that is all in with investments, so capital markets and wealth management. They're doing ETFs as well. So those are like clearer strategy. For CIBC, it's not too sure. I'm not too sure where they're going, and this starts to hurt them a little bit more. But for all the others, they're pretty much trading at the same valuation. So not necessarily a specific deal. My favorite remains National Bank and Royal Bank, but full disclaimer, I do have both in my portfolio, so I'm probably a bit biased. To end this video, I would like you to tell me which is your favorite bank, and most importantly, why. So I'm gonna see you in the comment. Let me know which one you love and what do you think is gonna happen in 24 with them. And until next Thursday, don't forget to stay invested.